Hey everybody, this is John and welcome to the free video. The FOMC has come and gone, and surprise, surprise, the markets continue grinding higher. I was going through, especially this weekend, I was very, very surprised at the amount of doomsday stuff that had come out over this past weekend. And some of the things that I found is that when you get a higher number than usual amount of that stuff, it typically means exactly the opposite. And what's fascinating about that is we're in that period of time, the last 2 weeks in September, the first 2 weeks in October, when it makes sense that there's going to be some big nasty correction. And the fact that there's not, and the fact that the what I call surprisingly alarming amount of bearishness and the surety of that bearishness really is just setting us up to do exactly the opposite. At the end of the day, the only thing we can do is stay on the path of least resistance. We do not want to argue with the markets. We do not want to impose our will on the markets. Okay, so if we look at the Qs, we have a daily squeeze here that has fired. And keep in mind that if you look at the weekly chart, and it's not as attractive on the Qs, it's more powerful on the Nasdaq, you'll see that a weekly squeeze is just fired. Okay, the last weekly squeeze took us a nice ride up, and the question is, are we going to see an equivalent move this time around? Well, the main thing is that there is no reason to fight that. And we've got earnings coming up on key stocks like Amazon and Google, and I'm going to talk about that in a minute because we do not want to miss the key stats that is coming up with those stocks. The other, of course, with the Nasdaq here, you've got Apple, which is trying to stabilize here. Okay, it's not really catching up so much quite yet. You've got Netflix, of course, which had a nice breakout and is now kind of getting its act together, so to speak. And then from there, some of the key stocks like Nvidia, poised to rip to new highs, as is AVGO, which has had a really nice move today. We did pick up some December at-the-money call options on this one today, and they're like $12, but you've got earnings out on the first week of December, and now you've got a stock that's poised essentially to rip. And I like how, and by buying them out in December, you're actually taking advantage of a kind of a continued rise in IV for that expectation in earnings. So it kind of holds on to that premium. So I like that quite a bit. So let's dive into this. All right, so we're coming up across earnings season, and I spoke with Eric. For those of you that are familiar with Eric, of course, Eric Purdy, he does develop some very cool tools, and one of them is an earnings analysis tool. And we had a good discussion about some other things that are just needed for this in order for us to make accurate decisions. And so a couple of things he's done on this that I think are really great is that you get the average by quarter. So the average Q4 move for 6 days prior to earnings. So whatever happens with earnings, 6 days after that, what's the average move in Q4? A down move of 3%. In Q3, it's an up move of 2% over the next 6 days after earnings. Q2, up move of 3%, and then Q1. That's super, super valuable information in terms of how to position into earnings. A couple of other things here that actually are awesome is the average pre-earnings IV. Now I meant to do an arrow there. The average pre-earnings implied vol, and then the average drop. That's obviously very, very helpful for IV crush. Couple of other things in here. Of course, you can see over the last 3 years, we've had 10 gap ups. The average gap up has been 4.3% or $42 with a max of 13%, $128. We've had the there have been 6 runs of 5%, okay, after earnings. But what's interesting about this is that when Google runs up after earnings, okay, you can see here that, let me get my arrow again here, you can see that the corresponding move into earnings is actually pretty small. So if it's actually kind of flat for the 6 days prior to earnings, it then tends to have a nice run after earnings, okay? That's actually super, super valuable information. The other one I thought that was interesting is that if it does rally into earnings, in this case, with an average rally of 2.3%, then it actually tends to sell off after earnings. Anyway, Lots of very, very cool stats in there. You can go in here and see that here was the last gap, and uh, the, the the move at that day ended up closing down 3%. Prior to that, closed up almost 4%. And it just gives you a lot of data that you can use for earnings. From there, the other big one, of course, is going to be Amazon. And if we look at Amazon and how that's been, average Q4 has been flat 6 days after. Average Q3 has been flat, right? The big move has always been in Q1, which I think is kind of fascinating there. So we want to keep an eye on that. We can see that the average IV is 39%, the drop of 13%. And then keep in mind that the if you get a flat move into a flat run kind of into earnings, again, it corresponds more with an up move. However, if you get a rally into earnings, like over 3% 6 days prior, it corresponds with a down move. So again, some very, very cool stuff in this tool. So let's find out more about this tool. So we are going to be doing an earnings class. And in this earnings class, we're going to be talking about a couple different things, but namely the plays for runs into earnings, day of earnings, and then, of course, what happens after earnings. Now, that tool I just showed you is an integral part of it. But there's another tool I want to show you as well. But just so you guys cut to the chase here and you know what's going on, and if this is something you're like, wow, this looks fairly interesting, because nothing beats math. You know, you can use your opinion and guess and things like that too. But when you have the math to work with and then you're able to back test it, it trumps everything. And that's what this opportunity is. So the class is going to be on Saturday the 21st. And for those of you that know the CML backtester, we're going to have Ophir join me on that class. And we're going to go through specific back testing sessions that you can essentially box up the strategy that's going to work best for an earnings trade. It's not to go over all the different cool things that you can do here, but essentially the short version is you can sit there and say, okay, if 2 weeks before earnings on Google, I bought a Delta 40 call, how has that worked out of the last 10 times? And it'll show you exactly how it worked. And then you can go in and tweak it and find the best, or was it a Delta 20, or was it a Delta 50, or would it have been better to sell a put spread, or all that kind of stuff. And then what happens is you can match the right option strategy to that stock. And on top of that, you can use the data in this tool from Eric to maximize it. So I'm super excited about it. And on this Saturday, we're going to be diving into that in terms of the strategy class. The professional package is going to include 3 days of live trade, or actually more than that, 5 live trading sessions where we're going to be trading not only the big name stocks that you guys are all familiar with, but keep in mind that there's a lot of low-hanging fruit out there in the stocks that nobody really pays attention to, okay? And then that tool I just showed you from Eric, that's included in this class, which is pretty awesome. The Elite package is essentially also includes a 6 months membership to our Gold membership plan, which includes text alerts, a live trading room, a forum, nightly videos, and essentially is a way to kind of join the community and get trade alerts and help all the time. So anyway, this is going to be a lot of fun. Let's take a quick look at the highlights here. So on this strategy class, and if again, you just go to simplertrading.com/quarters, you can read all about it. How to trade option position sequences instead of rolling the dice on a single position. How to exploit earnings reports on these under the radar stocks. How to trade. Oh, that one's in there twice. It must be really good. Rookie mistakes to avoid if you're new to trading earnings volatility. Like some of the worst things that you can do. We'll just kind of get those out of the way. And then we're also going to be talking about things like if you've got a small account and you're looking to grow it rapidly versus wanting to take advantage of earnings to create income, okay? And on and on and on. It's going to be a very, very powerful class. And to give you an idea of the CML tool, if you haven't seen it before, you can also, not only can you do this with earnings plays, but you can also back test our own squeeze indicator on this. For example, it'll say, hey, if there's a squeeze, and you buy a Delta 90 call on Microsoft 30 days before, you'll get an 81% return and you win 10 times out of 2. Okay, and this is very valuable information. You can do the same thing with these earnings plays, which is so valuable. So with this strategy class, the 497 class, it comes with a lifetime discount to that CML tool. Okay, so that's an important piece of the puzzle. If you're just by going through that link, you'll save thousands of dollars over the course of a multi-year subscription if you choose to stay with it. Of any tool that we've found out there, this is something that pays for itself pretty much quicker than anything I've ever found. Okay? Anyway, good stuff. Again, simplertrading.com/quarters. Looking forward to seeing you guys at the class.